All right, let's jump right into this explainer. What we're doing today is a definitive, top-down strategic postmortem. We're cutting through all that noisy headline chatter to look directly at the underlying market structure and the raw capital flows that are, actually driving valuations right now. So if you want to understand where the smart money is hiding, and trust me, it's moving fast, and where the structural traps are, well, you're exactly where you need to be. Here's our strategic review framework for today. We're going to move clinically through the data, starting at the macro level with volatility and yield pricing, then we'll drop down into S&P 500 technicals and options gamma, followed by a deep dive into the frankly brutal capital rotations happening in AI hardware, software infrastructure, and finally, we'll wrap up with niche sectors and some fresh crypto risks. Let's get to it. Section 1. Macro volatility and yield pricing. We're looking at geopolitical noise versus quantitative hedging. Let's look at how algorithmic capital is digesting recent escalations. Over the weekend, despite skirmishes between Iran and Israel and these really concerning threats to block the Strait of Hormuz, what actually happened? Well, quantitative trading robots aggressively bought the intraday dip. Why on earth would they do that? Because the market is pricing this as short-term noise, betting that diplomatic pressure will ultimately suppress sustained volatility. So, unless we see a full-scale war, which obviously changes the entire equation, algos are just treating these geopolitical escalations as routine volatility harvesting. It's totally a machine's market right now. But there's a secondary, much more dangerous effect going on here, and that number is 4.5%. As oil prices rebounded on all this geopolitical news, it pushed the 10-year Treasury yield right up against that critical 4.5% threshold. And guys, for the stock market, this is a structural red line. The literal second we flirt with 4.5%, it triggers an immediate mechanical sell-off in rate-sensitive sectors.
Just look at the utility sector. Utilities are basically acting as a direct inverse yield trade right now. Rates go up, utilities drop. It's that simple. But let's look at CenterPoint Energy, ticker CPG. They were already facing this macro rate pressure, and then they went and announced an 11 million share dilution priced at $28.10. The market absolutely hammered them with a 7.7% drop. The massive takeaway here? High dividend sectors currently have zero margin for corporate missteps. You make a mistake in this environment, and you get punished.
Moving right along to Section 2, SPX Technicals and Options Gamma, focusing on structural vulnerability right at the 7600 level.
Beneath those headline index highs you see on the news, our SPX diagnostic panel is showing a clear rejection at the 7600 resistance level. But actually, what's way more concerning is the momentum row. We're seeing a high-level bearish MACD divergence. What does that mean for us? It means the price is making higher highs, sure, but the underlying buying power is actually fading fast. I mean, after a 19% rally over 9 consecutive weeks, which is the best run we've seen since May 2020, the sheer exhaustion is palpable. Absolute bullish momentum is quietly evaporating right under the surface. And the options market perfectly confirms this exhaustion. We're seeing this massive, glaring divergence. On one side, you've got passive overextension, relentless retail call buying in SPY, QQQ, and semiconductors, just pushing gamma to absolute extremes. But look at what the smart money is doing. Institutional capital is preemptively buying puts on the small-cap IWM and layering long positions on the VIX. Institutions know we're heading into an event-dense window, and they are aggressively buying up portfolio insurance while everyone else is just blindly chasing the rally. Which brings us to a major risk factor, gamma unclenching. The current market is basically being propped up by passive, mechanical call option buying. If that retail demand drops even a little bit, the structural support just vanishes. Dealers will be forced to unhedge, and that risks a violent liquidity vacuum straight down to the Bollinger Midband, the 20-day moving average at 74.30. We are looking at a highly vulnerable passive structure right now.
Okay, let's pivot to Section 3, AI hardware capital rotation, the old 7 versus the new bottleneck.
The surface of the AI trade might look intact, but beneath it, capital is violently rotating to find new bottlenecks. Look at the core catalysts. First, Anthropic's IPO filing is reigniting AI risk appetite, which puts massive pressure on OpenAI. But the crazy part is Micron, ticker MU. The stock jumped 6.6% and its options trading volume actually exceeded the SPY and QQQ combined. That's pure retail mania. Now Goldman Sachs projects memory supply tightness through 2028, which is fundamentally great, but technically, it's a massive red flag. This kind of extreme options volume is a total carbon copy of NVIDIA's peak back in July 2024. It's signaling imminent technical overheating.
As that capital desperately searches for value, we're seeing the rise of what we call the old seven. Check out this rotation. Legacy tech companies from the 2000s, Cisco, IBM, Dell, Nokia, Lenovo, they are seeing massive inflows because they have mature supply chains and actual proven value moats to handle AI infrastructure buildouts. Conversely, previous Magnificent Seven darlings like Meta and Tesla, they just suffered synchronized 5% intraday drops on zero fundamental news. Capital is ruthlessly rotating out of overvalued megacaps and piling into legacy hardware infrastructure.
And NVIDIA is capitalizing on this shift perfectly. Here's their logic chain. Step 1. NVIDIA launches an ARM-based RTX AI superchip built specifically for PCs. Step 2. Giants like Microsoft, Dell, HP, and Lenovo immediately integrate it. Step 3. The legacy x86 PC chip makers, Intel, AMD, and Qualcomm, suffer massive valuation compression. I mean, Qualcomm dropped nearly 9% on this news. NVIDIA isn't just selling chips anymore, folks. They're successfully establishing a tollgate royalty system across the entire Windows PC ecosystem. It's a real game changer.
Let's move over to Section 4, Software Infrastructure Recovery, getting a much-needed valuation reality check.
Remember earlier this year when the market panicked thinking generative AI would make traditional enterprise software totally obsolete? Yeah, actually, scratch that. That narrative is officially dead. Q1 earnings data completely invalidated it. Instead, software is being repriced from a discretionary tool to core AI infrastructure. Because of that, we're seeing a fierce sector-wide valuation recovery. SentinelOne jumped over 9%, pushing right up to its annual resistance. CWN gapped up following its NVIDIA platform integration, reclaiming its monthly moving averages. The bottom line here? AI is enhancing, not replacing, these platforms. Software is establishing a new fundamental floor, so these pullbacks aren't sell-offs, they are structural buying opportunities.
Finally, Section 5, Niche Sectors and Crypto Risks. We're looking at rapid micro-asset repricing and some real structural breakdowns.
This is where we see the most aggressive moves. Look at the sector divergence matrix. Despite all the geopolitical heat in the world right now, traditional defense isn't booming. Major contractors like Northrop Grumman and Lockheed Martin are suffering severe technical distribution, breaking down below their 200- and 250-day moving averages. Meanwhile, the space sector is pure speculative volatility. Capital rapidly fled RDY and Loon, which dropped 15% after a rocket failure, and rotated straight into SPCE. The takeaway is simple. Do not blindly buy into geopolitical themes just because they're in the news.
Where the smart money is actually deploying is into structural monopolies. Just look at this institutional demand. The Quantium IPO just got upsized to $1.46 billion because institutions heavily oversubscribed it, targeting a massive $14.3 billion valuation and dragging IonQ higher with it. And over in traditional markets, Berkshire Hathaway just bought homebuilder Taylor Morrison in an $8.5 billion all-cash deal, sending the stock exploding up over 22%. Institutional cash is being absolutely ruthless right now in hunting down monopolies, whether that's in cutting-edge quantum computing or essential housing. Now let's talk crypto, specifically MicroStrategy. Look at this number, 32. That is the exact number of Bitcoins MicroStrategy just sold. I know, it sounds incredibly small for a company holding billions, but trust me, it changes everything.
Here's why this is a structural pivot. They sold 32 Bitcoin for about $2.5 million at an average of $77,135 and issued $128 million in new stock. The transaction itself? Tiny, a drop in the bucket. The impact? Massive. Bitcoin immediately dropped to $71,500, its lowest since April, and MSTR stock got hammered. Why? Because MicroStrategy shifted from this almost religious we will never sell ideology to standard, flexible corporate balance sheet management. By breaking that core corporate dogma, they completely shattered that illusion and severely rattled retail crypto longs.
So, this brings us to our final strategic risk matrix. The data is staring us right in the face today. Capital is actively rotating out of overvalued AI megacaps and into legacy hardware. Option dealers are aggressively hedging for downside risk. Traditional safe haven defense stocks are technically breaking down. So, here's the critical question you have to ask yourself today. With all this going on, are you positioned for a violent liquidity gap fill, or are you still out there blindly chasing a 9-week mechanically exhausted rally? Immediate portfolio reevaluation isn't just a suggestion right now, it is mandatory. Think long and hard about that as you look at your allocations this week. Thanks for joining me for this briefing, and I'll see you next time.